Hey guys, welcome to yet another lesson. In this lesson, we're going to be discussing the accrual concept, which is also known as the matching principle. It's very relevant when you're doing the income statement, but we have been doing income statement since 2011. So this is just to remind you of something, and then you can be able to apply it more when you're doing something like an income statement, and make sure that you're able to calculate your incomes and expenses in a correct way. So without wasting any more time, let us jump straight into it. So let's start with the learning objectives of this is to understand why we need to make adjustments. So typically what happens is that they will give you a question, and they'll give you a pre-adjustment trial balance, and then they're gonna give you adjustments so that you can make when you're doing the the income statement. So you need to understand why you need to make those adjustments, because typically what happens when these things get recorded, they get recorded in cash, and then you have to make adjustments to make sure that you're matching incomes with the year in which they happened or were incurred in. And then be able to define some key concepts such as accrued income, prepaid expense, deferred income, and all those other words. The difference between accrual and cash, this is very key. It's also very key for cash flow statements. And then you also need to know how to determine accrued expense, accrued income, prepaid expense, and income received in advance, which is also known as the deferred income. Why do we need to make adjustments? Financial statements are always prepared for a 12-month period. So you have a 12-month period in which you need to prepare income statements, and you need to make sure that you are matching everything to the year in which it belongs. So each company has its own 12-month period. Financial statements are prepared using the matching principle or accrual systems for incomes and expenses. Income statement should tell you a story of what happened in the business for a period of 12 months. So so you should tell me how much rent was I entitled to for a period of 12 months. If someone paid me rent for 14 months, the other 2 months, just don't include them because they tell a story of another period. But you need to tell a story of a 12-month period. How many sales were generated for the past 12 months? How much rent income was earned for the past 12 months? So that is what is important. You don't include the other months that fall outside the current year. So let's look at the definitions here. So the first thing that you have there is an accrued expense. So these are expenses incurred in the current year but not yet paid, e.g. used telephone but not yet paid to the service provider. It is quite clear. So if you use airtime, keep calling people, and then they send you an invoice at the end of the month, and you haven't paid it at the end of the year, that will be an accrued expense. You would have to include that in your expenses in the income statement. And then in the balance sheet, you'd have that as a liability, which is called the accrued expense. And then we have prepaid expense. For prepaid expense, these are expenses that have been paid but not yet incurred. So let's say, for example, you pay an insurance premium for 2 months outside of the financial year. For those 2 months that fall outside the financial year, that is a prepaid expense. The expense itself has not occurred yet, but it has been paid for already. That's what pre means. Pre means before. And that will be an asset. It's an asset because it's a result of paying someone more than now they owe you a service or they owe you a refund of your money. And then the following one is accrued income. This is income that has been earned, which means service goods have been provided. So say, for instance, someone is renting and then you give them your rental for 2 months, but they still haven't paid you. Well, you still have provided the service, so you have actually earned the income, but you haven't received the money for it. And that will be an asset because that looks like a debtor, but we call it like an accrued income. If you're a person that specializes maybe in giving out property, then that would be debtors to you. Yes, so there will be accrued income, and also you'd have to include the amount that is not yet received to you at the end of the month if it relates to the months that are within the current year. Then lastly, income received in advance. This is income received in money but not yet earned. So a tenant that pays for 3 months in the following financial year, for example, even 1 month, those ones are paid. That income you have received in advance, but you haven't provided the service yet. You haven't provided the service. So if you haven't provided the service yet, you're not yet entitled to that income. So you have a liability towards the person that is giving you their money without you providing a service to them. And then we just have an example here. So you can see here we have an extract of a pre-adjustment trial balance, and then we have adjustments at the bottom. So in the pre-adjustment trial balance, we have insurance sitting at 12,000, rent income sitting at 70,000, electricity sitting at 10,000, and interest income sitting at 15,000. We won't total this one up because it's an extract, so it will not, the debit and credit column wouldn't equal here, but they would have to be equal if it was a full pre-adjustment trial balance. So let us go into these adjustments. So the first adjustment, it says the insurance premium was taken on 1 August 2018. By the way, the year end here is 2019, if you can't see it. It was taken on 1 April 2018 for a 12-month period. So you paid for 12 months. So that would be from August up until 31st of July 2019. That's the period you paid for. But you know that the year ends on the 29th of February 2019. So March 2019, April, May, June, and July, they fall outside the financial year, and therefore that will be regarded as a prepaid expense, and that amount that is paid in advance or that amount that is prepaid, it will not be included as an expense in an income statement. Then rent for March and April has already been received from the tenant. So the tenant here clearly, they've paid for 14 months because there's 2 months outside the financial year that have been paid for. 1,500 is still owing for the electricity used in February 2019. This has not yet been recorded, so this is an accrued expense. We've used electricity, but we haven't paid for it yet. And then the business has a fixed deposit of 200,000 with ABC Bank, 15% per annum. Interest was last received on the 31st of August 2018. So let us go and answer and see how the income statement would look like. So this is an extract of an income statement for the year ended 28 February 2019. So let's start with the rent income. Rent income, so obviously we have 70,000 that we given here, and we're told that the 2 months after the financial year included, so that would be rent for 14 months instead of 12. So you divide by 14, and then you find that rent monthly is 10,000, and you want to make sure that you exclude the rent for the 2 months that fall outside of the financial year, and therefore 5,000 times 2 is 10,000, and then that would be your income received in advance, which would be under liabilities in the balance sheet, and in the income statement you'd subtract that 10,000 from the 70,000, and then you'd have a rent income for the year ended 28 February 2019 being 60,000. Cool. And then insurance, if you remember well, insurance was taken on 1 August for a 12-month period. The 12-month period from 1 August would end on the 31st of July 2019. And that would mean that so it would mean that the months that fall outside would be March, because it starts after the months after 28 February 2019. It would be March, April, May, June, July. So it would be 5 months. And that's the case there. So insurance paid for 12 months, 12,000 divided by 12. So we have a monthly premium of 1,000. And then months outside the financial year is basically it's 5 months, which is March 2019 to July 2019. And then the prepaid expense in that case would be 1,000 multiplied by 5. And then you'd have to exclude 5,000 from the 12,000, and then have an insurance expense for the year to be 7,000 in the income statement. And then you'd have a prepaid expense under your assets and the balance sheet for 5,000, which is the prepaid expense relating to insurance. And then after that, we have electricity. So if you remember that 1,500 for electricity is still owing for the electricity that is used in February 2019. This has not yet been recorded. So since it is since that 1,500 has not been used, it means that we've used electricity, we have not paid for it. So in other words, we have incurred the expense. So we need to record that expense. So it would be 10,000, which was this amount here for electricity. Then we'd have to add 1,500, and then we'd have electricity expense for the year being 11,500. Then lastly, interest income. If you remember, we said the business has a fixed deposit with ABC Bank at 15% per annum, and then the interest was last received on the 31st of August 2018, and the 15,000 there. So if you calculate interest income at 15% for the year, that would give you 30,000. In other words, if you said multiplied by 6/12, you get 15,000, which is what has been paid. So we received 15,000. We were supposed to receive 30,000 for the year. So the amount that is still accrued, in other that the amount that is still receivable, in other words, accrued, it would be 15,000. And you can see there that then we have to add the accrued income. So 15,000 plus 15,000 and give us an interest income of 30,000. And then in the balance sheet as of 28 February 2019, we'd have a prepaid expense under assets of 5,000, and then accrued income of 15,000, and then under liabilities would have income received in advance of 10,000, as well as an accrued expense of 1,500. These two under assets would typically be included under trade and other receivables as just one line item. And then these ones here would typically be included as one line item, which is trade and other payables. And that brings us to the end of the lesson. Hope you guys have enjoyed it, and I'll see you on the next one. Cheers.